technology, as we all know, has the power to transform insurance business models and also has the potential to improve pricing, underwriting, claims assessment, and payouts. It gives rise to new markets and value propositions, but complex regulation and capital requirements have restricted innovation and startups and created challenges in privacy and data protection. So our first panel of the day, will focus on some InsurTech applications, the opportunities they create, and implementation challenges in the inclusive insurance space. I'd like you to welcome our three panelists, Mr. Tang Luek, Ms. Monida Musikabud, and Mr. Vinay Kumar, who've all joined us from France, Thailand, and India, respectively. If you could give them a warm welcome, please. Tang is of French and Chinese descent, and he's the founder of P2P Protect, which launched a unique P2P insurance model in China under the brand Tongju Bao, excuse my pronunciation, and is now expanding to Europe and the United States. P2P Protect collaborative insurance model brings users together to share risks at fairer costs, fairer claim treatment, and with more transparency and user empowerment than in traditional insurance models. It also develops mini or microinsurance products that address social or family issues that traditional insurance usually ignores. Before that, Tang built multiple financial services activities on 3 continents for several large international banking groups. So without further ado, I'd like to hand over to Tang, who's going to, I think, keep all of your attention for the next 10 minutes or so. Thanks a lot.
Thanks a lot. First, I would like to say that when Catherine invited me, I was still a fit speaker. I just lost my voice on the transit in Doha coming here. So I hope I will be able to hold until the end of the presentation. We were starting from the ideas of allowing people to protect people, which is really at the core of the history of insurance, before the insurance became a very sophisticated and very regulated industry. There is different models which can allow to protect people. So the traditional insurance, as we know it, is a centralized model where people transfer their risk to a central actor, which is an insurance company. So the insurance company to be very strongly regulated and organized to be able to guarantee this risk. The concept of mutual insurance, which develops in many countries, is coming from the fact that the members of the mutual insurance concept should be the owner of the activity to reduce the conflict of interest between the owners and the beneficiary. But it still adopts the same centralized model for operating and is operating under regulation which is very similar to the one of centralized insurance. What we see developing, or sometimes redeveloping because it's to some extent a back to the basis, is different form of mutual aid platforms, or what we call peer-to-peer risk sharing. So what we started developing in China first and now in Europe is a model where the members are protecting each other. So they enter into a form of risk-sharing contract between each other, according to which they share the risk directly. So instead of having an insurer in the middle which is guaranteeing the risk, instead of transferring the risk to a centralized insurance company, you are sharing the risk within communities. It works for certain type of risk. I'm not saying that it works for 100% of the risk. We may come back to that later. But in China, I've seen also a lot of mutual aid platforms being developed, which are slightly different in terms of legal structuring, and I will try to explain it a bit later. So the two models coexist in China, and the mutual aid platforms has taken a lot of speed as well. Between the risk sharing and traditional insurance, you have a few companies which develops as what I would call peer-to-peer broker. In fact, they don't refer to themselves as peer-to-peer brokers. They are refer to their activity as peer-to-peer insurance, but basically it's a peer-to-peer distribution under a brokerage license where at the back of it you still have insurance company providing the insurance product. So this of course has the advantage and the comfort for the insurance regulator, for example, to have an ecosystem which from a regulations point of view is totally similar at the end of the day as the one of the insurers, because you still have an insurance behind, obeying by the regulation of insurance. The inconvenience of this is that, of course, it cannot bring as much innovation to the user as risk-sharing models, because by definition, the broker can distribute only what the traditional insurers are doing, so it limits the capacity to innovate in terms of either what type of risks are covered or how they are covered. So I'll have two views of peer-to-peer insurance. One, which is a Western view, and the other one is, which is what will you see if you focus on China and you see something very different. If this was not done by me, it was done by Rick Hucksteps, which is one specialist in insurance innovations working for the digital insurers review, and he's identifying different ways of attempted peer-to-peer insurance models, starting from the distribution model, where you see more companies like the one I mentioned, like the first one being French Insurance in Germany, which have operated under a peer-to-peer brokerage type of models. You had, after that, a second wave of people who are trying to structure the risk themselves. So it provides more added value in a way, but in a different models. And those models can become self-governing to the extent that they try to give back the power to the user, to give back the power to the member to take decisions on where this is leading. If you look at China, you have quite a different pictures with something which, so ourselves, we are more in peer-to-peer risk sharing, but most of the platforms define themselves as mutual aid models. And what is fascinating is that if you look at the amount of the users they have, I circled them in red in case you're not fluent in reading Chinese, but you have 1.6 million users for this one. You have 17 million users for Shuiti Husu. You have 9.6 million users for Zhongzuo. So you have several actors which really reach scales and were able to bring a lot of people together to help them on this. So they have been usually concentrating on specific risk and populations which are not reached by the insurance coverage usually. So, for example, I think that several of them started by trying to cover critical illness, things such as cancer, etc., because most of the population, so especially in a country like China where the insurance penetration remains low, you have large portion of the populations which are not covered among critical illness, and they have an appetite for that. But they do it into a model which is quite different from what the insurance is doing. Instead of having a fixed premium, they have a very low contribution by each member, and this contribution does not cover for a fixed period. In fact, you put a very small amount, 10 RMB, and whenever there is someone in the community which will be impacted, then this amount will be reduced from the account of every one of the members. And when the account of one member is reduced from 10 to 3, then he's requested for a top-up. So either he does the top-up, and then he continues to benefit and protect the other, or he doesn't do it, and he will lose the benefit of being protected himself. So it's a different concept of the risk money against the time of the protections, which allow to give the flexibility and the resistance to a certain degree of uncertainties in the frequency of the event, because it's allowed this top-up. Of course, we have nowadays a lot of actors taking interest in blockchains in the field of insurance, and in particular, the blockchain being a decentralized peer-to-peer network, trying to apply it to decentralized peer-to-peer insurance is something which is tempting. And I will not go too far into it today. It's a fascinating idea. It's not so easy to make the perfect match. And as we all know, blockchain is something which is not so accessible in terms of concept for a lot of people. So if you want to bring a blockchain concept to the emerging populations, then if you were to explain it, you'll be lost, because already it's not easy to explain insurance concept. So if you want to explain blockchain on top of it, you have no chance. So you can do it only if you can use it, but not speak about it. And I feel that today a lot of people like to speak about blockchain, but the fascination for the buzzword is sometimes stronger than the reality of the delivery. I'm not saying it will last. I'm sure solutions will be fine to fix it. You told me that we have a bit more time than expected, so I'm not rushing, but now I need to. Okay. So, what kind of issues those different time models try to resolve? So the mutual aid is focusing on the very low penetration of insurance in low income. And there is also an issue of the adequation of the pricing of a typical insurance product to low-income populations, which is addressed by that with very low contributions and with additional call when needed. Another thing on which we are particularly working, as for us, is that we feel that there are many social risks which are not covered by traditional insurance. In China, we've been working on divorce, on child trafficking, on migrant family precarity. Some of those, well, divorce is really bringing also a financial stability risk. It's in many countries the second biggest cause for over-indebtedness after the loss of job, but it's not actually covered. So that's the type of thing we do. Well, obviously, very often insurance is perceived as a bad answer to a real problem, with the impression that the money is going there and is not coming back. So that's one of the things we try to address with money back logic. And the negative perception in many countries is exacerbated for the youngest generation. So for us particularly, we focus on bringing everything back to the user. So we bring the money back to the user, we bring the power back to the user, and we bring the information back to the user. Let me go through this. The money, so in our models, we get people to make an online deposit on an online account, which is covering the cost of risk. What is compliance-wise interesting is that this account is open in their name. So there is no transfer of the money. We are not collecting the money to put it in our bank account, in our pocket. It remains the ownership of the user. But by isolating it into an online account and by having the user giving us a mandate according to the term of their risk-sharing contract to operate this account, this allows to have an account which is there to pay the money and ensure that the money is there. So this money is going 100% to the community. Either there are accident risk, in which case the money is paid to them, or there is no accident, and then the excess of the rest money is going back to the community at the end of the period. So that's one of the money back elements, which is building trust, in fact. And it's different type of trust. And insurance, the trust is built by huge reserve. There, the trust is based on the fact that, okay, if the money is not used, it will go back to you. It speaks a lot. In terms of going back of the informations, in insurance, you go to an agent, you sign a one-page summary, and there is a 40-page contract behind that nobody is reading. And people realize the content of those 40-page contracts only 5, 6, 7 years later when they have an accident. So if they are lucky, they are super happy and they love the insurer. But if they are not lucky and there is an exclusions, they are extremely frustrated and feel that they have not been treated fairly. For us, because people protect each other, we can give the information every month, and every month we send report and dashboard which tell to people, you have a committee of 5,000 persons. 150 claims this month, 120 accepted, 30 rejected. The 30 rejected, you have 12 rejected for reason A, 8 for reason B. So people learn every month. There is a learning curve which is built back into the concept of insurance. And that's allow two things. It's allow when there is an accident, people not to be frustrated because they know already the reality, what is protected or not. And it allows something else. It allows us to give back decision power to the user because we allow them to vote not on an individual claim, but to vote on how they want to shape the product coverage for the future. And that's worked pretty well because they are very reasonable. It's not like in the insurance logic, there is this impression that either the money go to the shareholder of the insurance or it go to the user. So people try to drag the money to them. But here, they know that if people claim too much, then they will have less money back at the end of the month. So we see that in the practice of the vote, they are quite reasonably prudent. And they are learning really, this is a learning process about what is the reality of risk logic, of an insurance logic. So there is more teaching, I believe, about how insurance works in this model than with a traditional insurance model. We do a lot of social media usage. In China, of course, that's easy because people are so much on WeChat. We use Facebook in Europe. So different type of products, there are a lot of social or societal risk. In Europe, we are starting by working a lot with NGO, with associations, fighting against over-indebtedness, supporting victims of terrorism, or other of these type of missions. We find that that's good to build communities. Users like it, very good retention at 90%. Some virality at 60% of viral recruitment. I don't think that insurance reach those levels by far, so this is user recognition. And well, what do we? Regulators. Well, it's sometimes difficult for regulators, right? Because regulators are held responsible for ensuring the financial system stability. And innovation, by essence, is movement. So by definition, it has not been time tested. So we just hope that, and we are sure that regulators also consider their mission is to facilitate and nurture innovation to improve user coverage. And well, as entrepreneur innovators, we need you, for sure, the regulator, to allow us to survive long enough to prove the value of what we try to bring to the users. And the final message is innovation is frail. There is so many ways a regulator can kill innovations, not even knowing it, not choosing to kill it. But about some regulator stories, I won't go in detail, but the first one is that there is a lot of unintended death case. Not because the regulator want to quick someone. In 2016, in 17 in China, I've had call from the regulator who was very nice. He said, oh, we've seen what you're doing, the insurance regulator, and can you add the disclaimers there on your first page of your website and change this here so that people know that you are not really insurance regulated. And we did it, and we loved it. That's a very nice, light touch way of a regulator to tell us what we shall do. But the problem is that they didn't do that only, but they also provided new regulation for the peer-to-peer lending industry. And when they did it for the peer-to-peer lending industry, they said, all right, this is a framework which may apply in the future to the peer-to-peer finance industry. But in the insurance field, detail of the regulation will come later because lending, it was urgent, insurance, it was not urgent. And then what happened when you have this? Then you have people who are your partners or your investors who say, oh, the regulators say he will issue a new regulation maybe in 8 months or 18 months or 2 years. So we need to wait. And when you have your investor or your partner deciding to wait for the regulator to take a decision, then you are totally frozen. And as an entrepreneur, you have the time to risk dying 10 times before something happens. All right, so I'll stop there. And so you've understood the ideas. We really need a soft touch from the regulator. And we may survive some level of uncertainty because it's our mission as entrepreneur. But remember that our partners or investors will not be willing to face it. So if you freeze them, it may kill us indirectly also. Thank you.
So it's my pleasure to thank Tang and thank you. There's some tea there. You got it, okay. And thank you for battling with your voice. I know that can be really quite a challenge. And it's also my pleasure to welcome Monida here. Monida is the regional head for AXA Asia Emerging Customers segment and has been working with AXA strategic partners such as leading mobile network operators, or MNOs, and financial institutions to offer customized and innovative insurance solutions to low to middle income populations in emerging countries. Monida has over 15 years of experience in working in leading business strategy consulting firms. In fact, we share an alma mater there. And also in the insurance industry. So, Monida, without further ado, I'd like to hand over to you. Thank you.
Thank you. So, I'm Monida from AXA Asia. So, today I just want to really share with you what we do. And to my humble opinion, we are new to this, comparing to our colleagues there from many countries. So, let's start with what AXA visions, right? So really, AXA Group's vision is to empower people to live a better life. That's why we put emerging customer and financial inclusion as one of our key strategic pillars. We want to protect people who are aspiring to live a better life, which is an emerging customer per se. And we want to protect the future middle class. So people in emerging customer right now will be a middle class segment in the future, and it's our future customers. So when we talk about emerging customer in AXA, who are they? Basically, they're accounted for 70 to 75% of total population in emerging markets, and usually lower income or low income segment. Of all our customer, of 100 customers, 85% of the customer never have insurance before, so they are underinsured or uninsured. So imagine they don't understand insurance. Traditional channel of insurance, like agency or bank insurance, overlook them. So it's quite a new market comparing to the more affluent market for insurance company. When we start looking in emerging customer and AXA, we know that we don't know anything about this segment. So we know that we have to rethink how we can serve them, right? That's why we rethink about the customer journey. The customer journey in AXA consists of, I broke it down into 4 buckets, which I will talk later on in each bucket in the slides. But the first bucket is customer value proposition. How can we make their value proposition as simple and relevant product? So insurance company usually want to add a lot of coverage into one product, right? Just to make sure that it's comprehensive. But with this segment, usually we have to look at what is really relevant to them and affordable for them. Another thing is offering beyond insurance. So I just want to give you a broad idea. In AXA Group, as total customer of, let's say, 100 customers, only 20 customer claims. Another 80 people buy insurance but never claim. Either they don't know they have the product, or either they don't have the incidents to claim. So basically, they're paying for that peace of mind. So we want to give something back to them, not just protection. So we have the concept in AXA that we call from payer to partner, because when you look at insurance company as a payer, so if something happened to you, you just get money from insurance. But we want to be a partner. We want to walk with you along the way, not just only when you have an incident. The second bucket, which I will touch on, is about distribution. So we have discussed today in terms of blockchain technology and other innovations. Really, for this customer segment, which is really new to insurance, it's almost impossible to teach them the new process of getting insurance, right? So we want to build in insurance into their lifestyle, so like seamlessly integrated into their lifestyle, buying foods, going to mom and pop shops. So they don't have to learn the new concept of buying insurance, right? And also balancing with customer protection in terms of data, customer data protection, and insurance penetration. So we work with governments, regulators in Asia, in other part of the world, to make sure that we can have this balance, which I will discuss later in distribution. Enrollment. We usually have, I give you an example, in Thailand, we have 1 million customer base, but with adding on another 23 million customers from emerging customer, we cannot manage. Our system, we just don't know how to manage these millions of customer more. So we have to think of the way, partner up with startups or tech company that can help us processing these kind of transactions. And last but not least is about service and claims. For this segment, how fast we pay claims is as important, if not more, than whether we pay claim or not. So we really have to pay claims on the next day for the minor claims. So that's the crucial thing. And also another part that I would like to touch on is delighting our customer in a cost-effective way. So how can we delight this customer who never, have a chance to talk to call center before, because like telco never want to invest in their call center to talk to this segment. How can we delight them more? So those are the things that we have to rethink about approaching to emerging customer. I mean, in AXA, we don't say that it's to do emerging customer initiative. It's not understanding insurance. It's more understanding emerging customers. Understanding the customer, right? So, sorry. So in terms of value proposition, I will not go into details, but basically we look at the 360 offerings of value proposition. The one key thing is we simplify the term and conditions. So as Tang said that insurance usually have a lot of exclusion, and I'm sure in this room nobody ever read about the policy, right? So what we did is we strip out all the exclusions. So imagine my actuary team. So we strip out all the exclusion or very limited exclusions because it's hard enough for them to understand insurance. It's even harder for them to understand the exclusion, right? So that's why we manage the risk by other ways and taking out all the exclusion that is not relevant to this segment. For example, like personal accident, the exclusion is not flying your own jet plane. I mean, right? So we have to rethink about how we develop a product, right? And also make a product as a bite size for them. So instead of 1 year product, we do 1 month product, daily product coverage, itemized product that just on the go. If you want to hop into Grab bike or Uber bike or something like that, then they can just buy protection for that one. So make it easier for them to take the insurance product and smaller price. These are the products that we usually offer with customers. So personal accident, term life, and credit life, and hospital cash. I think this is a usual suspect for emerging customer, and it's cover basic needs. After we can identify who really interested and have a demand for additional product, we can add on critical illness or crop insurance or motorbike, but we rather protect them at the basics coverage first. And in terms of designing the product communication, we have our rules that our product have to be able to explain within or less than 2 minutes. So meaning that this product can be put online to be able to explain and not losing the customers, right? There's no claim forms, no ID document required. So we make the product very easy, and this we have to work with the regulator in order to for them to allow us to do so. But you know, because of emerging customer and microinsurance is such a high priorities in regulator minds nowadays, so it's not difficult to work with them. In terms of distribution, I gave you one examples of we did. So we try to design the customer journey in terms of distribution as easy as they getting top-ups for their phones, or they buying foods in the mom and pop shops. So what we did launch with one of the leading telco in Thailand is we used a similar process. Basically the similar process as top up mobile phone online to buy insurance. And we talk to the regulator, not just only insurance regulator, but we talk to telecommunication regulator, financial regulator, other banking regulator, to make sure that we can convert mobile airtime into insurance premiums. So those are the things that before it's deferring us from approaching to the customer. So I mean, in the future, we are hoping that we can use other currency for customer to buy insurance. Either it be like loyalty program or any allocation portion or points from the government or anything that they can use this to pay for insurance from the past. And another point is that in terms of KYC or licensing, those are the things that we have to look into because it's a factor that deferring us to spread insurance more into the lower income segments. Then when we talk about enrollment, I love to use this analogy, which is like the way we designed back-end operations for usually traditional insurance. We design it as a sport car, where you can take a more affluent customer on a very good experience, but you can transfer only 4 to 5 people in the car, right? And it's a high touch customer experience. However, when you want to put in millions of customers, your sport car no longer be able to achieve it. That's why we invest in a company called Microinsurance, who provided us bullet trains, where we can move millions of customers faster. It's more online. You have mobile solutions. It's easy to use, and we're working in Asia and in Africa and South America with Microinsurance to really process fast and large transactions. And then last but not least. So this is how we delighting the customers, right? We working with startups, with fintechs, and with insurtech in order to make sure that we can delight the customer more. For example, mobile health or talk to a doctor with a very cost-efficient way that can support both feature phone and smartphones. So I mean, because as I say, 80% of people never claims. Sometimes because they don't have time. Emerging customer that I talk to, usually they work 6 to 7 days a week. So I mean, if they got sick, I mean, they don't have time to go to see the doctor. So we talking to the local startups and regional startups in terms of providing a telemedics kind of service, which is lower cost. And all the chatbots and or preventive discussion on mobile health. In Philippines, the parents who are emerging customers who are hoping that their kids can do a better life than them, so they're always looking for like education consultancy or advice. Then we work out with their startups who provide like a source for social scholarships and advice on the school. So that's something that we can help delighting the customers. Also, to reduce the cost of contacting the customer, we also installing a chatbot through our call center as well. In terms of claim notification, we make it easy, so it just put in live chat or WhatsApp. So the customer just put in their name, and we have develop an application that capture that and then put it straight into our straight through processing claim. So there's no human intervention in terms of claim processing, and we can play claims within next day or maximum 3 days. So that's really what matters for the customers. In terms of claim payouts, we use all our partners, like the payment application or mobile wallets to pay claims, fast claims. So just want to wrap up, right? Really, the emerging customer in emerging markets is accounting for 75%. So it's more than half of the customer addressable segments, right? And at this time, from my view, I think it's a tipping point of all the technologies, all the readiness of the regulator, that we can align every interest and design a win-win-win situation for this segment. And we have to rethink and work with InsurTech, work with big tech company, our partners, distribution partners, in order to really reaching these high potential markets. So that's from my part. Thank you.
Let me meanwhile introduce Vinay. Vinay Kumar is the founder and CEO of Aria.ai, which is an autonomous deep learning platform for enterprises. Vinay founded Aria.ai in 2013 along with Deekshith Mala and a team of 5 researchers. Aria's customers include leading banks and insurance companies in India and in Europe, and the company is also part of an InsurTech accelerator program set up by Swiss Re in 2016. Vinay was listed in Forbes Asia 30 under 30 in 2016, and he's the youngest member of the Artificial Intelligence Task Force set up by the Indian Ministry of Commerce and Industry. Since 2015, Vinay has given more than 30 public talks on deep learning in the United States, Europe, India, and Hong Kong, so we're very fortunate to have him with us here today. Please give him a warm welcome.
Good morning, everyone. I think we have built a lot of things. Having compatibility for multiple PDF formats is one of the challenging tasks, I guess. Anyways, good morning, everyone. My name is Vinay Kumar. As introduced, we are a deep learning platform. So deep learning is one of the ways you can build artificial intelligence. So AI is and has become a buzzword in the last couple of years, right? It has been used in autonomous cars. It has been used in multiple use cases as well. I think in insurance, that's one of the areas where it could have a larger impact. I think in insurance, there are 2 disruptions, right? One is in business model and the other is in technology. Technology is where you would see a massive pace because there is already base framework set up by the industry people. So you have claims process, you have all these processes. Adopting to technology is much simpler and faster when compared to a business model. Probably that could be where regulators would be a challenging task, right? So here we are trying to address AI. Everybody wants to use AI, but the problem is how. What are the ways that it can be done? What is the time period? What are the resources? So it's kind of set up by the industry that AI has to be used, but there was no path line to adopt it, right? So that's where we come into play. We believe we could automate the process of using AI. So probably that could be the quickest way you can adopt AI. Where does a human has to build an AI system? Can it be self-built? Can it self-learn? Can it able to automate fewer things and multiple things going forward? So that's the kind of goal that we have. We believe eventually the process of building an AI can be completely automated, wherein you can just define a task and the system can be built all by itself. Again, that's a scenario where it can reach to a singularity phase. But our goal is to approach there as quickly as possible. Yeah, I think when it comes to AI, right, so there are multiple ways that you can build a system. So one can be a rule-based system. So the other can be self-learning and autonomous. So rule-based system is where many of the classic AI systems are. So today everybody is using a rule-based system, if not a self-learning system. Rule-based is where you define a rule, you write an ML, machine learning, classic machine learning is a completely a rule-based system. Wherein you write a rule and the system will use a rule to interpret the data, be it in fraud detection, be it in anomaly or behavior pattern analysis. It can be any kind of task. You can write a rule to make the system learn from the data, right? The problem is you don't know what the rule to write for. When it comes to process automation or when it comes to fraud detection, there are innumerable amount of rules, right? All you could do is you could write 60 of them or maybe 70 of them, but there are still thousands and thousands of rules you are yet to write. So that becomes a challenging task to build a comprehensive system. Then the next answer is, why can't it be self-learning? Meaning I give the data, let the system write its own rules and let the system learn from the data rather me writing the rule, right? So that's the most easiest way, most fit way to build an AI system. So that's where deep learning comes into play. So deep learning is nothing but neural networks, which is more comparable to any biological being. So in any brain, in any biological brain, you have neurons, right? You have multiple millions and millions of neurons, sometimes billions if it is a human. You have billions of neurons, and when you give a task, there is a communication between the neurons. So that is what our learnings are. Our experiences are nothing but a neural learning, right? So that's the same thing that is what replicated into machines. Can we just build a larger and larger brain and just give the task? Let the brain figure out the rules, right? So that's what a deep learning system is. And then third thing is autonomous, meaning let's say I built a certain problem. One of the challenging things in any problem is data is changing. There is changes in behavior. There is changes in patterns. So every time you don't want to design a new system again and again. Can the system self-learn and can the system self-optimize, right? For example, instead of building multiple modules like claims one module, underwriting as another module, distribution as another module, can I build a single insurance AI, one single AI system that can do all the things? If that's the case, then it has a better opportunity to optimize, right? So that would be more like an autonomous system. But the challenging thing to build autonomous system is you need massive amount of data, which might be a challenging task for many of the players today. But self-learning systems is what ready to deploy, meaning if you have a certain amount of data, you can use deep learning. You can actually automate the process. So that's where we come into picture. But there are a few challenges in the industry. And in fact, so you can use deep learning for multiple use cases, be it for process automation cases, which is classic case where I want to extract information or I want to automate something kind of scenario. And then you have intelligent automation. So intelligent automation is where it's not a simple thing to do. You might need a certain cognitive analysis. You might need certain decision kind of scenarios. For example, claims automation, right? So claims automation is a very complex process depending upon what insurance product is. And then you have efficiency level systems like risk monitoring or fraud detection. These are the few efficiency systems that you can use. In fact, for every use case, you can actually use deep learning. And some of the challenges in the industry is deep learning is very new, meaning there are not many people who can understand deep learning and build a deep learning product. There is a large amount of gap between the demand and the supply. So for example, every large company wants to have their own data scientist. Every large company would want to have their own researchers to build the product, but there are not too many researchers available in the market itself. Our estimation is there is less than 15,000 researchers in deep learning, and there are less than 50,000 people who can understand deep learning as a concept. So, but the requirement is more than 1.4 million in 2017. So the gap is very, very massive, and the gap will continue to grow because as when we see more and more adaptability, the demand grows further and further, but the supply is fairly less, right? And second thing is inadequate performances. So we have been hearing that a certain bank is using deep learning, but when we ask them, has it gone to production? Many people says that they are using deep learning in one way or the other, but the problem is many of the cases, they are still in testing. They are still in testing and testing and testing. So this happened even in the last 3-4 years where everybody wants to use new technology, but it stopped at the testing phase. It might not be able to go to production for multiple reasons. One of the reasons can be the model has not delivered the performances required. And then and the third challenge is the expensive ops and maintenance. So deep learning needs massive computing power. It cannot run on CPUs. You need a huge amount of computing power, right? And fourthly, there is a lot of changes coming into the market. So for any enterprise, it will be a challenging thing. How fast can we cope up to that? So those are the few challenges that we are trying to address by building, by automating the process itself. So we believe by automating the AI process, we could actually see a lot of adaptability. And by building a replicable and scalable stack, you could actually see a lot of risk management when it comes to hardware or other kind of tasks. And the other thing is this platform has to be learning from the user. Meaning, let's say to build a deep learning model for claims, it took me 6 months. And to upgrade the same model, it shouldn't take the 6 months time period again and again. It should be more optimized, right? So in that case, you need a platform that can learn from the user and optimize over the period of time. So that's what ARIA does to the enterprise market. So as a product, we have different kinds of product and product modules. On the fundamental level, we have Vega. So Vega is a workbench which sits on your data layer. Your data layer can be a data lake or database, or it can be business tools itself. And it sits on top of that data layer, and it will become an intelligence layer. Vega has multiple tools, frameworks, which is addressing primarily to a data scientist. And then above Vega is what we have modules. So modules meaning pre-built solutions, standalone applications. In short, it's an ecosystem for enterprise apps. So we already built multiple apps in banks, insurance, and IoT. And if you wanted to use the same modules, you don't need data scientist. If you're trying to use these modules, those are self-learned unautonomous modules. Meaning you just give the data, it can self-optimize, it can self-build the model, and it can create you an API which can be integrable directly. So that's a key advantage of those modules. For example, in insurance, as I said, one of the classic cases where a deep learning or AI could be used and have a straight-through impact is claims process. So claims process is one of the places where you're spending a lot of money, and that's where you could actually optimize better, right? In fact, 20 to 30% of your expenses goes through claims processing, and the rest of the processes are distributed among it anyways. So we have deployed the platform and the module in one of the large private insurer. The problem statement was more or less the same. It takes a lot of time, it's too expensive, and the customer experience is not good enough. So these are the three key and there is also frauds. These are the 4 challenges that are there in any insurer, in any insurer, not just in insurance in India, right? Globally, the problem statement is more or less the same. It takes a large amount of time. It takes at least 24 hours to settle a claim. And it needs for example, if it is a health insurance product, you need doctors. It cannot be done by a normal underwriter. It cannot be done by a normal person. So then your expert's value is also very high. And there is a lot of frauds that is coming into the market as well, right? So automating or increasing any efficiency on that process is a direct impact on your business. So, but it's very tough to build an AI module because there are multiple data sets that comes into play. For example, if it is a health insurance product, you have different set of knowledge coming in from different data sources. So one is claims information will give you the actual financial data. And then the hospital information will give you the situational information, like what was the diagnosis, what was the situation, what happened before, what is the doctor is recommending, right? And then you have user dimension, which tells you that whether this is an authentic case or not. So you have multiple dimensions of data come into play when making the decision. And as I said, there are a few challenges, like for example, fraud is a major thing in health insurance, not just in health insurance, also in general insurance as a whole, right? A massive amount of frauds are happening, and these frauds will continue to increase. There is always a new pattern that a fraudster could leverage, right? And there is a claims leakage as well, so you might be overpaying them or underpaying them. That's another risk that is there. Increasing fraud and time-consuming process. So these are the few challenges that we want to address. In fact, our process is, we took the past historical information. So we actually took more than 4 years of information. We gave it as a part of the training data. We gave it to the module, and the module has learned it in 8 to 12 weeks, depending on the data and the computing power. Once it has learned from the data, our performances are currently the system capable to automate 85% of the claims. This is one of the best metrics that is available globally as well in the health claims information. So it can automate more than 85% of the claims within first quarter, and its precision is more than 95%, meaning whenever the system predicts that this claim has to be accepted and the final settlement amount is so and so and so, its precision is about 96%. And it took us less than 12 weeks to go to production, meaning we have removed the dependency of researcher or data scientist. We have removed the dependency of data tuning and data parameter tuning, and we have removed the dependency on model tuning process. So this actually impacted around 30 to 40% operational cost directly in the claims processing. So there's a massive operational cost saving for that industry, right? So this is just the beginning of the insurance adoption of deep learning. So claims is one piece, and then another important piece is underwriting, right? So in underwriting, you are seeing a lot of new data sets in the market to understand a customer. How does that can be embedded into an intelligence? And another feedback is also your claims data. So if your underwriting model is very good, your claims will be very less, right? Or at least in an optimized manner. So that's how an underwriter would always look at it. That's how a business would always look at it. So that's our next piece of deployment anyways. So eventually what we want to build is an operating system for insurance business, AI operating system for insurance business, a single platform that can address to multiple modules, not just to claims processing. For example, we already have an underwriting and pricing module for a life insurance. And then we are now building a customer 360 module, primarily targeting the distribution channels. So in Insurer, you have multiple channels of distribution, right? You have agents, you have online, and then you have digital products as well. How can I optimize it? How can I make a system efficient enough such that it can allocate the resources automatically? So that's a customer 360 product. So we are trying to build modules for each and every phase of or the process of business, targeting a customer, onboarding them automatically, and then issuing the policy more personalized to that user, rather building a bucket-based kind of pricing model, and then automate the claims. And this is also feedback data to the system, meaning an ideal insurance business would target a right customer and give him a right policy, and then efficiently optimize their claims, right? So that's a kind of model which works for insurance, is what our belief is. And insurance is where we would see this model to be deployed really quickly, in a financial industry. And the next business could be lending or some other businesses where there are very less mobile processes, and it could be able to automate by building an AI module. So this is just the beginning for us to deploy in insurance. We already are expanding our business, not just in India, but also to Singapore, UK, and all the other micro universes, which are a lot more matured in terms of the financial products or the data sets. Okay, I think this is just the beginning for us to deploy deep learning, and we believe this could be a larger or the key crucial time for any insurer to think about the technical stack. Currently, you have your framework ready, right, which is serving a larger set of audience. Now that framework needs to have and should have AI as an enabler. Unless you have that, there will be a lot of other players who could jumpstart and be a larger risk in that business. So I think we are excited for the insurance business, and we believe insurance could get disrupted in next 5 years than in the past 50 years, and it could grow further and further in an exponential phase in the coming years as well. We believe regulators are geared up to that kind of change. We don't want them to move with 30 kilometers per hour, where a technology is moving 150 kilometers per hour. So regulators is always a question for us as well. For example, we don't know where it could be deployed, where it cannot be deployed, or if it has to be deployed, what are the metrics of it. So those are the few things that we will always look from the regulators. More transparency and speed of building a policy in a certain geography. Because what we are seeing is the regulators' impact is not just in a business in a geography. It's also the development of the geography itself, right? For example, India as an example. So Prime Minister Modi has recently put up a policy saying that we will have 50 million people, 50 crore people more or less, 500 million people to be insured. So there is a large amount of penetration yet to be done. If that penetration has to be achieved, you cannot do that by having a current stack. Then there will be a massive amount of risk on your business. So you need to have a new stack. If that stack has to be deployed, regulators has to give a lot of clarity for the insurance and for the startups and also technology providers in terms of how and where it can be deployed. Yep. So that's my presentation for today, and looking forward for your questions. Thank you.
Thank you, Vinay. So I'd just like to kick off our discussion. Is this working? Can you hear me? Yes. Okay, good. I'd just like to kick off our discussion by asking each of the speakers some questions, and we will be opening up for questions from the floor. So please bear with us. So Tang, I'd like to start off with you. And I know you've been in the business for a long time, but how does your business differ in China and in France? Could you perhaps comment on the differences between the working in the two regions?
Sure, thank you. So we started in China, right? So the history was not exactly the same when we moving to France. We are moving on top of something on experience we have already. But basically in China we started and tried to launch it on the B2C basis, going directly to the customer in a market which is very, very fast moving by every standard. And really one of the characteristics of China, for me, compared to France, is that everything is going very, very fast. So when you're moving to Europe after that, you need to adjust to on one side to a much more mature market, where first the insurance penetration is much higher, of course, and the space available and the speed at which you can implement things are not exactly the same. So when we moved to Europe, we've been trying to have a more B2B or B2B2C approach by identifying which are the existing partners as in the insurance finance world, or other existing entity which can be from telco to non-governmental organizations on which we can leverage. In China, you have so much space and you try to just rush to get the user as fast as possible. In Europe, you need to learn about much more patience.
Thank you. And in terms of managing client retention and data protection, so Manita spoke about the need to educate customers. Well, has that been your experience in China, and how do you protect their data?
So that's kind of two very different questions, right? About the education and the retention, I shall say that our challenge has been to gain the initial understanding and trust of the new user when we try to convince them to join us. But due to our models, we are really a model which is putting a lot of emphasis on returning the information. So the learning process is built into our business model. And this is generating also a very high natural retention. Why you have understood that we have also this element of money back. So the fact is, the day at the end of the period when the user needs to decide whether he wants to renew or not, correspond to the day when he's receiving the money back due to the excess money. So this is really the day when he's saying, not only those people are telling you that they will return you money, but they really do it. So if I have sometimes difficulties getting people to get on board first, we have a very easy path at convincing the people to renew, because it's really falling at the right time when they have a great experience.
So I guess that a big question is then whether that model could be applied successfully in other developing regions where, or with other customer bases where uptake of insurance is very low, and trust is also very low. Perhaps that's something we can return to. I mean, Manita, do you have insights into that?
So really, as you say, the trust is low, especially for emerging customer segment. I think one of the things that we have to look for is influencer. Either it be corporate influencer, meaning that people that they can trust. For example, mobile phones or any corporate that they use it every day and it works. You know, if it works for them, and if this company or this influencer introducing insurance to them, meaning that those company already screened, the solution for them. So that's why I think working in with partners, working with people who already touched the customer is a very crucial thing. Yeah.
So you also mentioned that you, as AXA, are investing in insurtech startups and inclusive insurance startups such as Microinsurance. And I wondered what your strategy is in going about things that way, and what the criteria are for these investments.
Okay, so at AXA we have one business unit called AXA Lab. AXA Lab have office in Paris, in San Francisco in the US, and in Asia we have it in Shanghai and in Singapore. So this AXA Lab will responsible for screening the whole Asia, the whole region, to see potential startups, insurtechs or fintechs that we want to work with, and we're looking into a sustainable partnership. So meaning that we want to work with them for a long time. And after we spot a company, we'll get connected to them, and either we partner up with them, like for example Uber, or which is our global partnership, or we invest in them or buy out. So it's depend on the different partners. And for emerging customer, we really look into people who can help us in terms of cost efficiency improvement, like Microinsure, or something that we can delight our customers, like I mentioned about mobile health, or some education or maternity solution. Some people for big data. I mean, we have big data team within AXA Lab, but working together to develop index insurance or parametrics insurance. That's another area that we are looking at. Beside from that is also the way how can we get the new data, like AI. So in the US, we're also looking AI into company in terms of how we can manage a motor claim better. So we don't have to send inspector to the location. We just let the AI to learn that if this kind of accident, how much we're gonna pay. So we keep learning. So those are the things like that we are looking forward to. Yeah.
But now, I mean, AXA is a huge company, and you must have an enormous R&D division. So why not just develop these solutions in-house? Why look at external startups?
Because we are insurance company, we don't do other things. I mean, with AXA, we don't set up a bank or other business, and we believe that other people should have better idea than us. They know what they're doing, like P2P insurance, and we're also talking to P2P lenders and all the P2P insurers, right? So I think it's really more like we are, as an insurance company, how can we leverage on the passion of startups or big tech firm to be able to give a total package back to the customers. Yeah.
Great. And Vinay, I mean, implementing deep learning tools such as the ones that you're describing, especially given the scarcity of supply, that must come at a cost. So can the insurance models for emerging customers actually absorb the costs that are implied in terms of developing the AI systems?
Yeah, I think as developing internally would be a really challenging task. As I said, there are always a new technology to build something. And the pace of new technology is changing very quickly. For example, in our standards, right, whatever you have built 1 year back, deep learning itself, it's obsolete now. There are better performances, there are better architectures, and there are better hardware as well. Unless you have that kind of scalability / adaptability internally, you are investing in a very wrong product, right? Because in 1 year it's going to become obsolete. That's a very, very challenging thing for any enterprise to look at. So that's where we as a startup are bringing that kind of, we are bridging that gap by providing not just the services, but also the product upgrades. For example, when we are deploying a claims module, developing internally, it would definitely take more than a year to develop a module, test the module, and then go to production, right? For us to deploy the same module in any business, in any geography, it takes less than 3 months. 3 months is like a very, very good metrics for any enterprise, right? So we are providing that kind of metrics because we have invested a lot around the module than any insurer would look at it. We always seen some challenges also. For example, we as a technology company, we don't know how an insurer would work. Hence, we work with the insurer to understand what is a process, where it could be automated, where it could be enhanced, or where it can be planned as phase 1, phase 2, phase 3, and then go to production in the phase 1 as quickly as possible. There is always co-working that we always see with our customer. It may not be just like a SaaS module like you could see with any software product. An AI product is more touch-based product. It's not a 2-year deployment, right? You would always see some upgrades in the next 5 years as well.
Well, that sort of brings me back to the essence of the question, which is really, I can see the efficiencies and how those would work from an economy perspective for high-end customers where the margins are higher. Yeah. But inclusive insurance that is targeting emerging customers, microinsurance, and so on, this is a high-volume, low-margin business. So Can AI really deliver the solutions that are needed in a way that lowers the transaction cost? Because that is what would make it really attractive. And
yes, definitely. I think one of the there are two areas where you are spending money, right? As a business. So one is to develop the module, and one is to pay in production. For example, if it takes a lot of time, a lot of people, a lot of resources to build the module, then you are spending a lot of money. That's more or less a direct investment that's going into that module development. Even when we talk to a customer, our deliverables has to be really cost effective. And the next thing is production. So once a module is in production, how much I'm paying on day-to-day basis? Is it matching my cost savings or not? So as a business, I would look at multiple things. For example, by having this module, instead of spending $10, today I'm spending $8. And I'm paying the technology $0.5, which makes logically good enough, right? So I think an insurer might have to look at those kind of modules in the beginning until they reach to a touch point where they are now largely tech-enabled. So it shouldn't be a problem for them to adopt to technology, right? So not adopting to technology is a bigger risk than investing in the technology. People have to look at that as R&D investment is a good investment. Product investment is a good investment. You may not see the business value in a short run, but in a long run, it always gives you ROI larger than any other strategy.
And has Aria.ai already been involved with inclusive insurance, or is this a still unexplored field for you?
We are exploring a lot of new businesses, actually. I think health insurance is where we are pretty matured. We are working with multiple insurers, both domestically and globally as well. And now we are making inroads in life insurance with primarily the underwriting module, which is where it has a larger impact in life insurance, right? And now we are expanding to other businesses like, for example, car insurance, and then you have home insurance. So you have all these general insurance aspects where the claims is a very larger occupier of your operational cost. We are expanding ourselves. I think it's going to be an ongoing task for at least next 5 years. Again, I'm saying the 5-year statement again and again. There will not be a maturity phase till 5 years. You could always see new business models. You could always see new technology coming into play.
So, I mean, we've touched on how AI and deep learning and insurtech can help insurance companies become more efficient. Perhaps we can bring that back to the value that can be added to the actual customers, and I think both of you touched on that in your presentations, but perhaps you'd like to amplify, starting with Manida.
You mean for like beyond insurance?
So how can insurtech add value to the customers,
right,
not just the insurance companies?
Yeah, sure. I think in terms of insurtech, I think different insurtech in terms of throughout the value chain, right? It touch customer in different way, but it makes insurance more accessible to customers because like I say, especially emerging customer, the agent wouldn't want to go to see this emerging customer because they cannot earn enough commission to do that. But it's different if we can distribute in terms of big volumes. Besides from that, it's fasten the claim process, right? Because claim is really a moment of truth of insurance. So I mean, either whatever technology, it's boiled out to human, right? So if we can play claims faster with no this argument, then that's really helped the customer in itself more than insurers actually, I think.
I think that the organizations are shaped by the regulations they have to apply. And if I'm thinking about the mutual insurance industry, I'm not speaking here about peer-to-peer risk sharing or mutual aid, but really the mutual insurance industry, which develops in many countries of the world with big ambitions of putting back their members at the heart of the decision process. I think their philosophy and vision was very close to what we are trying to achieve. But due to the overall regulatory framework, they are being pushed today in many parts of the world, especially in I see this in France, in merging in bigger and bigger organizations to be able to face the the market pressures of the private insurance. And I see them, even if they keep this overall mutual frameworks, becoming in their decision less and less differentiating with private insurance company. I think that if you think about what you want to deliver to the user, the only way to be sure that you don't lose your path and your directions is to find models which are giving back the decisions to the user. And the closer you can go to a form of direct democracy empowerment for that, the closer you will be, and you will achieve two things at the same time, giving more understanding by the user of what can be done or not, because they have a stake into it. And at the same time, you ensure that the decision remains driven by the need of the user. The financial regulations in banking and insurance is, of course, essential to assure the solidity of the system. But due to the framework that it's putting, it's really driving, I feel, also a lot of the actors in following the laws of organizations and becoming self-motivated organization, even if they are mutual in their foundations. At the end of it, the democratic process don't allow them to remain customer-focused anymore quite often.
So I was quite intrigued in your presentation when you showed the pictures of the members of the peer-to-peer insurance voting, right? I mean, that's pretty cool. And I wish that my insurance companies would ask me what I think and what I need, because even in Europe, this is not actually happening. So it's interesting that that kind of initiative is more advanced in this field, working with emerging customers in peer-to-peer insurance than actually in the developed world, where you would think there is so much competition for the customer's attention that more attention would be paid. But so my question really is, in a way, to you, but also to Munida, to say, in the world of health, we've had situations where models have been borrowed from the developing world, very famously, particularly the introduction of more primary care-based health systems. And I wonder whether insurers are looking at some of these success stories and democratization of insurance for emerging customers and then applying them back home. This isn't particularly directly relevant to microinsurance, but in terms of inclusion, I think it's particularly relevant.
So really, as we discussed before, I think peer-to-peer insurance is really going back to where insurance started, right? So insurance started with people just putting their money together and just to make sure that if something happened to the member, he or she would get paid. So I mean, as an insurer, we can play a role in that, just to increase the trust and to prevent some miscalculation of lending between, insure between each other. So what we did, like for example, in Thailand, where we have traditionally we have a funeral fund, which the member of the village just put in the money in case someone pass away. Then the money will go to the person to arrange for the funeral, because it's a belief that if you don't arrange a proper funeral for your ancestor, they will not go into the right place. So we go in and we say that okay, we will help you facilitating this kind of village funeral fund to make sure that it's not like the money that you put in the middle will run away with some person in the village, which happens sometimes. So we play as a role of helping them, facilitating them, using our expertise in terms of helping managing those things to happen, which is kind of mixed between peer-to-peer and also our roles in the insurance industry. And the regulator likes it because because then they're quite sure that is no false or fraud scam in the village. So that's one thing that we are trying to do for emerging customer.
Do you want to add to that? No, okay. So you've mentioned the regulators, and I think this is your opportunity to write your wish list. So, I mean, in terms of starting with Vinay, maybe working backwards, because I think, Tang, you already had a go at this one, but you're welcome to have a second one. In terms of what regulators can do to support innovation of the kind that you're talking about, and obviously it's different in different countries, but based on your experience and what you've seen, could you talk about some of the constraints that you've faced with your particular business, and how you've overcome those, and perhaps suggest how regulators can maintain their need to protect stability whilst also supporting innovation, particularly with respect to the application of AI to inclusive insurance. And part of this, of course, involves consumer protection, data protection, and privacy, and so on. Thanks.
I think one of the major, there are two challenges actually for adoption of AI, right? So one is data, meaning where is it coming from, and who owns it, and who owns the outcome of that data, which is primarily the intelligence, right? And then the second piece in AI is black box model. Meaning when we talk about deep learning and AI, in many of the times it's a black box. You're giving some data and you have a black box, primarily like a super intelligence, which learns from the data and which executes or automates the task. Some of the questions that we have faced from the regulator is, why does it make that decision, right? It always goes back, why does it make the decision? Is there any decoding model or not? It comes into play primarily in claims payment, right? When you're rejecting a claim or when you're rejecting certain proposal, you have to explain why you have rejected it. That's kind of a responsibility for the insurer to the customer, saying that because of so and so reasons, I'm rejecting your claim. So in the beginning, very beginning, when we looked at to deploy deep learning, we didn't have the decoding model, meaning the system is giving out the decision, and it's at par with the human process. It's kind of, and in fact, it's better than the human doctor's decision. And then regulators came out, in fact, the insurers also were particularly concerned about the rejections piece. Why does it make a rejection? In the human process today, they have reasons, right? Why they have rejected a claim. But the system couldn't able to generate those things. Then we re-looked at the data. Do the insurer have enough information to decode the decision? In particularly in claims, they have that information. Whenever they make a decision, they explain why they have rejected it. It might be in rudimentary format, it can be very unstructured format. Then we started embedding that capability into the system. Can the system read this unstructured / very rudimentary comments and replicate those comments when it has rejected the claim? So that's one way to look at, it's not a black box model as long as you have the data. That can actually solve a lot of regulators' questions, right? In fact, that's one of the reasons why we are seeing a lot of spike in demand. Even though there are solutions in the market, most of them are black box solutions. They give you 1-0 kind of decision, but they cannot explain why the 0 came out as an output. So that's one way to outcome that. And in fact, it's also responsibility of an insurer. If this has to be used in future to automate or to use AI, they have to start capturing it from now. In many cases, we are seeing the insurer's framework today might not be sufficient enough or might not be good enough to completely automate the process. You would always need that human touch in some way or the other, right? And when it comes to the data, which is always a classic problem with any data, with any AI solution today, so who owns the data is a classic problem, and what can be shared, what cannot be shared. It's still unclear, even though there are a lot of things that are available. That's one area where I would always see if the regulators could give us the clarity. And also the third thing is also use of AI, right? Where it can be used, where it cannot be used. If it cannot be used, what are the specifications of the outcome that the regulator look at? That also helps us to design an AI system or a product that address to those kind of use cases. These three would be the broader things from my end, actually.
Okay, great. Thanks for such a clear answer, Manuda.
Okay, so for me, I think really we have a continued discussion with the regulators in each country for where AXA is at, and I think I had to admit that lately the regulator is also introducing some new concept like sandbox, that we can put our innovation into the sandbox and try to test it out. And the effectiveness, I think, is different country by country. So, for example, like I just learned from Hong Kong that the regulator was quite shocked that they have like 40 application in 1 month and they don't know how to screen it and something like that. So, but in Thailand or in some other country, it might be different in terms of people who submitting the concept into the sandbox, and I think it's really go along with the competition in the markets and how. Sure that they think that their innovation is not going to be copied or shared with others players, right? But I think it starts to get there in terms of insurance sandbox. I think for me to further it more is that it's not just only insurance regulator who allow us to do the sandbox, because as you know, it's all connected, right? So if you want to do some innovation, it might have to go along with the banking regulator sandbox as well, or some telecommunication sandbox. So I mean, integrately in terms of building a new concept for insurance involve rather more than just only insurance regulator. I think there should be a forum or some consortium that can really help us in terms of bringing in new innovation which work in other countries or other developed countries and test it out in the market. Yeah.
Well, I think like Manida, I also like the concept of the sandbox, provided it doesn't become a bottleneck like the Hong Kong case you mentioned. Because of course, if there is a sandbox and only 5% of the applicant can enter, then this is an issue. But I think this is a healthy balance, and I'm speaking even so the model I've launched are in 2 countries, China and France, where the insurance regulator don't practice these sandbox concepts. Why do I think it's healthy? I think it's healthy because at the same time, it providing information and data to the regulator to see how things are developing. It's providing also some self-discipline, I believe, to the start of the new model who apply, because they know that the regulator expects to receive a certain number of data and they have to provide it. So instead of doing some things totally outside of the framework, they do it within a framework where they know the regulator will look at it. So it's also push into paying attention to what could be the concern of the regulator for the user safety or user protection as it goes. And at the same time, it also provide not perfect clarity. It's not a regulator commitment on the long terms, so that's understood. But at least it provide the clarity and the safety is that at the time you're doing it, you're not forbidden to do it. And I think that for the investors in a startup model, that's something which is also an element of safety. Even if it's not safety in the long terms, at least they cannot be reproached to have invested in some things which regulatorily could be rejected after a while. So it has a lot of merit all the way down. So I'm pleading for the sandbox models, even if I've not been able to benefit from it in my 2 markets.
Well, the sandbox model, I guess, inherently involves dialogue and learning from one another. And so in that spirit, I'd like to open to all of you for any questions that you may have for the panelists.
Yeah. My name is Naya. I'm from Pakistani insurance regulator. So my question to Mr. Tang from China is that regarding P2P risk sharing models, you said that 100% is either paid or it is returned. So how to manage the volatility or fluctuation in the claims experienced by the insurance companies?
All right. So the answer is different depending on the type of risk. So one thing we are clear with is that this is not a model which is fitting the coverage of natural catastrophe, because by definition, natural catastrophe, when it applies, can have the risk of applying to the full community or a large part of it. And this is a type of risk where I believe you need to be able to build up reserve for 20 years to cover the risk on year 21. So this is not the type of risk we're covering. We're covering risk of frequency, which can be better covered by spreading the risk within a groups. So how do we cover the volatility? When we define initially the amount needed to cover the risk against a given risk in a community, we start by taking the average risk as we can measure it. Then we add different layers. We add layers corresponding to the statistical distributions to be able to cover the a certain number of sigma of variations in the statistical distribution. We had a layer to cover the risk of negative bias of concentrations of the risk in the selections, and we had a layer also to cover for the risk of fraud. So when we have all these, we have embedded in the defined cost of risk all the elements which are supposed to provide for a significant safety margin. So a significant safety margin can give a 99% or a 99.9% safety. I will of course acknowledge that by definition it does not give a 100% safety, because even if you have covered 99.99% of statistical volatility, you can always have a statistical possibility that you are in the incredibly rare case. So to face this, you have two ways of approaching it. Either you need to provide for the possibility to call for additional top-up of the risk money, which is what the mutual aid model is doing. Or for us, with our peer-to-peer risk-sharing models, we provide in the risk-sharing contract for the user to agree that in case there will be really an extreme statistical distributions of the claims, the amount to be paid per person can be reduced proportionately. So you could have cases where instead of having 100% of the intended amount, you have only 98% of the intended amount, which will be paid. To tell the truth, so this cover to avoid the risk that you have a legal contractual default on the solutions. In the reality and the practice of it, we still have a relatively short lifespan, so we have only 3 years of history, but we never had cases where we were even close to be challenged, maybe because we were prudent at the beginning, maybe also because it generates healthy behavioral patterns from the members. And we always saw that people were, well, that the level of fraud and the level of negative bias was lower in our community than we would have expected at the beginning. So you have a kind of a righteous behavior patterns, which is also protecting against this.
This also goes to Tang Zhibao, because I would be interested how you are licensed. If I'm informed correctly, you're not a licensed insurer in China, right? And I would just like to understand like how you work in China and how it is also possible in different countries, like if you experience any difficulties there.
Obviously, before launching in any new countries, we are looking at the regulation of these given countries, and we are ensuring that our models, which believe can work on the non-insurance patterns, could be matching with the legal ecosystem of this country, right? We are not just trying to duplicate everything the same in every market. Already Uber has proven that this is not the right path sometimes, and we know that financial activities are much more regulated than the car transportation. So we are not going to do that. But basically, we have two things we try to be very careful about. One is related to the public money collections, because to collect public money requires a license from the financial and banking regulator in most markets. So you do it as an insurance, and this is called premiums, or if it is not an insurance premium, you still need to ensure that you are not doing an illegal public money collections. That's why we have a model where we are not taking the risk money from the user to keep it into an account where we put it on the side. We structure an online account, which is the account of each user separately, where the money is safe kept. So as long as there is no accident, so as long as there is no payment of an indemnity, you don't have transfer of this money, and it remains on the account of the user, the property of the user. So this is what allows us, in terms of legal structurings, not to have collected the equivalent of a premiums or of a bank deposit. The other thing is that in terms of construction, we have 2 layers models. You have one level, which is directly between the user. They sign between themselves a risk-sharing contract, which is a civil contract, according to which they commit if one of the 1,000 or 5,000 persons in this committee have an accident, they all agree proportionate to the amount of their deposit to use a bit of this money to support this person. But us as a company, we are not directly part of this risk-sharing contract. We don't participate in the risk. We are a service company which is providing the platforms and a certain number of service to each one of those members. But we are not directly guaranteeing the risk. And because we don't guarantee the risk, because we are not an insurance company, that's it. So that's the general idea.
I have 2 short questions, one from Tang and one from Vinay. I don't want to exhaust you anymore because you and I having the same problem. So, and in your slides, I saw that China also, penetration is very low in China, like in Sri Lanka. And the people always think that the insurance companies, they take your money and never pay you back. That perception is there. What is the mechanism to change that perception to get people attracted to these new tech models?
One of the difficulties for the insurance industry is that you cover from a risk which is relatively rare by definition. Well, if it was happening every year, that will not be a risk anymore. This will be a certainty, right? And the benefit of receiving the money happen only once sometime every 6 or 7 years. So this belief is related to the fact that you don't have a proof of the commitment of the insurance company and its delivery before it really happened. Then you have the issue of the exclusion and whether it really happened or not, but that's another thing. For us, with this model where the money is kept aside, but the money is returned at the end of each period, then it ensures that if the contract is a yearly contract, at the end of each year, the person will see the money coming back. And of course, the persons may, in most of the case, choose to reinvest this money to be covered for an additional year. But it can also decide to stop its contract, take back the money. So you have the proof of the payment, the proof of the commitments to return money to the user, which is delivered and demonstrated at the end of every year. If it was a monthly contract, it will be even more frequent, right? And I think this allowed that's give a very satisfactory feeling to the user to see that, yes, it's not only a promise, it really happened.
Thank you. When in India also, I know these people rely mostly on paper, the policy document.
Yes.
That's what people used to have for a long time. And we also have this, we have started mobile insurance, some of the insurance companies are doing it, successful, so far so good. But where the consumer protection is concerned, especially in grievance handling, when there is a claim, the companies, the regulator has experience that they go through the policy document. in absence of a policy document, are you working on a mutual trust, or what if that trust, they break the trust, violate the trust or whatever? So how do you settle, come to a settlement in that situation?
Sure. I think it's not one-dimensional, right? It's two-dimensional. For example, an insurer has an obligation to explain him what he's insured for. For example, in most of the cases, exclusion is what people would have confusion. They don't know whether it's under the insurance or outside the insurance. In fact, I faced the problem myself when I went through the same claims processing. I don't know whether my case would come under the insurance that I have taken, even though I have two different products. The classic case is I will call the call center and then try to make him understand what my situation is, and then get the opinion from him whether I should apply for a claim or not apply for a claim, right? That might still be until unless a customer would have all the information that need to be accessed in an easy accessible format. Probably in this case, as paper is a common mode of communication, it might be very tough until there is some agent, right? So agents are the most appropriable/reachable persons in our ecosystems, at least. Even in my village, agent is the guy whom we would be speaking with, not with customer care, not with somebody else. That would still be the problem statement for at least I don't know whether, as long as the distillation is not adopted in those areas. If the distillation is there, then there are many ways you can disseminate the information. If the distillation is not there, then agent is the only way that I could see at this point. But as an insurer, my obligation is always to explain him while purchasing. While purchasing is another area where you could have a touch point, right? Giving him the clarity in terms of what is an exclusion meaning and what are the cases that you can think about. Maybe creating a case study as well. This is what I could think in cases where paper is a major mode of communication.
We have a question here. I'm just going to use my privilege as moderator. One clarification, Tang. So you mentioned with the peer-to-peer model, the customer puts the money aside in an account that is still in their name, a bit like an escrow account. And at the end of the year, if there have been no claims, all of that money is, if that customer has had no claims, all of the money is returned.
If the rate of the claims in the community is low, the excess money is returned to every customer. So it's not based on your individual claim behavior, it's based on the community claim behavior, which is defining the money return.
Okay, and in terms of what about transaction costs? So, I mean, the transaction costs are much lower, but there are still transactions costs, so presumably it would be less those as well.
Sure, so when the customer is subscribing, instead of one single financial payment like the premiums in insurance, there is two separate financial operations. One is a payment of a fee, which is covering our operating cost, or at least when we are reaching scales, is covering our operating cost. The other is the risk money, and we totally separate the risk money from the operating fee. So this way there is a perfect transparency on the fee we are taking, and no confusions about what's the cost of risk and what is in fact the money which is used for other functions within the model, such as distributions, operations, reserve, etc.
My question is for Vinay. So most of us are working towards inclusive insurance. And when you say inclusive insurance, we are targeting people who may have not, or most of them have not availed of insurance before. And we know, we discussed earlier that artificial intelligence, deep learning, is all about data. It's data driven. Yeah. So my question is, how can you add value to this industry which the data is not available? And do you have alternative data sets that you can tap so that we can make use of artificial intelligence?
Sure. I think in this case, you might not have historical information of the customer, or even maybe the target set of the customer, right? And it becomes really challenging to build an automated underwriting module, or even any other thing. One alternative, as I mentioned, is other data sets, right? And the other thing that we are also trying to explore is sharing intelligence between the players. For example, let's say there are 4 or 5 players of insurance in that ecosystem, right? Not everybody would have all the data required. not everybody would have all the required data to automate or to even add value. If not sharing the data, can the players share the intelligence? To give you an example, let's say health insurance, right? Health insurance, you would always need more and more information about diagnosis because there is always new diagnosis, new equipments, new costings, vagera, vagera. An individual insurer might not have all the data that is required to understand what is the exact claim amount is. But if an ecosystem supports one and another by not sharing the user information but only sharing the health information in a certain format, maybe in a certain other manner, which could enable them to benefit as an ecosystem than an individual player, that may be another path to fill in those gaps. So, and there is also simpler ways, right? You can acquire the data from third-party sources and use that information for accessing your current use cases. So those two would be the use cases, those two would be the approaches. But again, I'm not sure in terms of regulatory, how does it work? That might have to be yet to be figured out, I guess.
Thank you. Just to give Tang a break, I guess, the question to Vinay, and I guess that is closely linked to the previous question about having data available in the inclusive insurance space. One of the risks that's been identified is that through artificial intelligence and algorithms, the analysis can be so granular, so thorough, that you would create subgroups of higher risks that then get priced higher.
Yeah.
And that may run counter to the objective of inclusiveness and may even lead to exclusion. Is that a genuine risk, and how can you address that risk, prevent that?
Yes, I think it can be built as part of the model. For example, you have sensitivity factor, right? For example, let's say I have a customer where the sensitivity is very high, meaning it's a very high risk kind of scenario. Then the premiums can be adjusted to that case. I'm not saying AI would work the best in this use case. It might be skewed towards the area where it has data. It might not be universally applicable to the users where there is not enough information. For example, let's say I'm taking third-party data sources as well, right? And I have that third-party data source might be rich for some users, might not be rich for other users. Then it would understand those users more than the other users, where even they don't have data. That might be another case where there might be skewness in AI system. That's where you could actually have a sensitivity factor to understand what is the scale of the risk. Is it low, high, or super high? You can always keep that as a metrics. And then depending on the metrics, you can optimize the premiums. So that could be an easier solution to build in this module.
So I'm Clement from FairFirst. We are also using telematics, user-based insurance, use-based insurance, and chatbot and AI, right, in order to improve and to give better service to the customers, right? So in that sense, of course, we don't need to go to the regulator, or right. So because it's internally, we are just managing using this latest technology. The challenge that we are having is, right, when it comes to the external stakeholders, right? If you look into the customers, right, customer want hard copies. If you look into the police, right, if they wanted to showcase some kind of a thing, they want a document. We can't just showcase some kind of SMS that we have received, or soft form of some kind of output. So how we all in that, or in your countries, that you all have overcome this type of challenges, what you have, because we feel that these are the bottlenecks that we have in our countries in order to make this utilize in a better optimized way.
I have two questions, but I have two questions actually. One is a general to any one of them, and one is specific to Mr. Vinay. The general question is that if we are talking about the use of InsurTech for inclusive insurance, but actually customers' journey does not end at receiving the claim or being intimated from the insurance company that the claim is rejected. Sometimes he obviously has to go to the dispute resolution forums. It may be an ombudsman, it may be a dispute resolution committee, or maybe tribunals. So, when the sum covers of such policies are very small, so how a customer can afford actually expensive litigation? So how to address the use of technology in that area? This is the one general question. Second question is from Vinay, is basically. I would like him to share his experience of implementation of artificial intelligence within different projects, because when an insurance companies aiming to adopt AI, So there is a conflict of interest of various people who are actually involved in its actually implementation, because when the processes are automated, they might lose jobs actually. So how the insurers have addressed that situation?
Yeah. So I think coming from the backwards, right? The last thing is loss of jobs. I don't think next 5 years we are losing any jobs. We are actually creating a lot of jobs. One of the reasons is penetration. For example, today you have in developing economies, at least, if not in developed economies, the penetration is less, maybe 15% or 20%. You have a lot of scope to improve your penetration capability, right? So let's say today I'm addressing 10 users in my insurance company. If I want to address 100 users, then I need a huge, massive people for claims, massive people for agents, massive people for this, which you may or may not be able to afford or even plan out, right? The easy way to reach from 10 users to 100 users is when you have a technology, meaning you are not replacing anybody. You might still be receiving claims by 3x growth or 4x growth every year. You are trying to address that growth with a part of technology and a part of human process. Our belief is you would start hiring more of your claims people than firing them, even if you're using AI. In fact, our belief is you would hire more people because you would increase your penetration. And when you have underwriting also driven by AI, your penetration can go 2x or 3x every year or 2-3 years down the line. Then your human resource requirement is very massive. Probably we believe that you would receive more job offerings than firing people. So that's one reason why we are seeing a larger penetration. And the other part of the piece, for example, in the litigation piece, right? I'm not able to touch. I'm not be the right person. For the other question, where you would need a proof of transaction or a hard copy or a soft copy, right? You could actually create a system which could create automated responses. You might have to train it properly, and you might have to create train on the document creation as well. But it can be addressed to some extent. For example, in legal documents, right? You might have heard about use cases where AI is creating a legal document when you tell the situation and the complexities. It can be handleable to very repeatable use cases, if not very specific use cases. So probably those are the two cases where even you can use AI and still have the flexibility of automating it and give the comfortness to the end user.
So I think just a comment on the middle question, which was about
the paper. No. I think for now for emerging customer, if we never have litigation, surprisingly, because the coverage is not that high. And we want to promote. Actually, we want people to claims. So every month we will send SMS to our customers saying that please claim. And if we usually do extra share for if the customer fall off of some condition. But I think in terms of I'm not sure whether I answer your question or not. But it really we don't see it yet as a top big concern for now. And usually because it's starting with when we decide a product, right? If we decide a product in such a sense that it's avoid the litigation case, then that's one thing. Another thing is that we never do underwriting for this emerging customer, so it's a package product, single premium, single rate. So that's why we do post sales monitoring or fraud monitoring rather than underwriting process, and because of the product is covering only on monthly basis, so if there's any potential fraud case, then we can turn it off quite quickly. So in the sense, we use the enrollment process and after sale monitoring to monitor fraud to make sure that there's no case to go into the litigation. Yeah.
Okay, great answer, thank you. So with that, I'd like to thank all of our speakers, all of our panelists this morning. Thank you for great presentations, great discussion and answers. Of course, everyone is available through lunch and for the rest of the day.